Welcome to Between the Vines. My name is Kevin Martin, and I'm here with Andy Muza. Good to see you again, Andy. Jennifer is at a conference this week, so she is not going to join us. And unfortunately, I think we're just going to keep talking about the same stuff we've been talking about. Also, unfortunately, it's actually not that repetitive. So, a lot of what I've been talking about is rising costs, and we are seeing more of that. So, it's more of the same. I don't think anybody's surprised by this. I would guess you're seeing this in your personal life as well, as you know, we saw the cost of a few goods go up precipitously. You know, on a personal level, it might be gasoline. On a business level, it might be Roundup. Now we are looking at some of those costs spreading across the production and operation of vineyards. So, one of the things we are looking at is, I think we knew that the impact of Ukraine was going to be widespread, a war and an invasion that involves powers that are important trading partners with the world, especially in the area of energy, relates to a lot of things. So a couple weeks ago, we talked about urea. A lot of the world's urea comes from Russia, not necessarily ours, but it's a global economy. So just because we don't buy it directly from them doesn't mean it doesn't have a direct impact. So like we said, we expect urea prices were rising a couple weeks ago. They are testing their more recent highs. So if you remember from 2 weeks ago, we had talked about how urea had fallen in price and now is going back up, and now it's probably on the verge of setting some records depending on where you're buying it from. Diesel fuel, same thing. I said, road diesel was well on its way to $5, and that has come and gone, and we're well above $5 now. At least in New York, it'll be under $5 on the farm because obviously you take all the taxes out of it, and but it's still 3 times more expensive as it was when it bottomed out. So essentially, what's happening there is the value of energy is going up, and things related particularly to natural gas as well are going up. So where that's going to hit grape growers, in addition to those things we mentioned a couple weeks ago, is drainage tile. So if you're thinking about a drainage project, drainage tile was very affordable, maybe not on a historic scale, but looking over the last 20 years, 3 or 4 years ago, the cost of drainage tile, like a lot of other things, bottomed out. It was around 37, 38 cents a foot for 4-inch. And now we're well over 60 cents, 65 cents in that range. And for smaller amounts, if you're doing repair work, it's going to be much closer to $1. So those costs are way up, and I think we're probably going to start seeing some of those major projects that we were probably expecting be put on hold because of those costs, which I don't necessarily think that's unwise. I think a lot of growers were really excited about investing some of this new money that they have. Cash flow was pretty healthy, and investing a lot of that money into the farm to grow the farm, and drainage can be a great way to do that. And I'm not really sure where the long-term price of drainage tile is going to settle out. This 65 cents is, we might end up here for a very long time. But I can see why it would be tempting to postpone this for a year and see what happens over the course of that year. Drainage tile is going to be an excellent investment, whether you're paying 65 cents a foot or 29 or 39 cents a foot. Either way, it's a great investment. You certainly want to get it done before you're in your 60s if you can, although a lot of farmers can't because you're building up your farm and you never have that available capital until you're at the medium end of your career. So we see a lot of drainage tile going in a little late, and I don't want to, I really would urge growers to consider investments like those and not necessarily put them off for a decade. But a year can be pretty important. Drainage tile can have a really big and positive return on investment in a single year. but it's all weather dependent. The years that we need drainage tile depend a lot on the weather. Um, and I'm sure Andy can comment on, how variable the weather has been over the last 20 years. And, sometimes drainage tile really doesn't do anything because we've got a drought. Um, so drainage tile is a big area where prices are evolving. And sort of related to that, when we're talking about big projects on farms, which is what drainage tile often is, we are seeing interest rates increasing very quickly. And this is also to be expected. The Federal Reserve in the US has sort of declared that they're going to raise their target interest rates somewhere between 6 and something more than 6 times, expecting that to be, a quarter of a point each time, or 1 basis point. So that means for a very large bank to borrow money, they would probably be paying, in the area of 0% 2 months ago is what they would be paying. And in a year, it looks like it's going to be more like 2.5 or 3% in that area. And the idea is to return to something above 3% very quickly. So you could see that rise to 4% in the next 18 months. So what that means is all other forms of debt that have the ability to change their interest rate, or debt that doesn't exist yet, that you haven't applied for yet, is going to have a higher interest rate. We've seen the cost of federal borrowing, so the dollars that the United States borrows, we've seen the cost of that on a 10-year note go from essentially zero in 2020 to now it is around 2.3, 2.4%. So we've seen the market immediately respond to what the federal intentions are to raise rates, and we're going to see higher rates in mortgages. We already have. And so what this will mean for growers is particularly the variable rate loans that growers utilize, crop loans, capital loans, like a revolving capital loan. Those forms of debt are going to get more expensive. If you're thinking about buying a farm, a mortgage on a farm is also going to get more expensive, even though that's fixed rate. If it's not fixed yet, it'll be higher when you go to buy it. So, how much is kind of a prediction that's difficult to make, but we know based on the current market that if you are in the world of debt that, say, existed 6 months ago, and your debt just hasn't adjusted yet. So like if you have a variable interest loan, it has some pretty important terms that haven't been very important in the last 20 years, but are about to be. So your bank, your lender is able to adjust that debt periodically. And it could be every quarter, it could be once a year, it could be every 5 years. It just depends on the term of your debt. They also might be limited in terms of how much they can adjust it each time. It could be a 1/4%, it could be a whole percent, or maybe it's not limited at all. That's certainly possible in commercial lending. So most variable debt like that right now is between 2.5% and 3.5%. Just based on what we've heard the Federal Reserve say, as quickly as those terms allow it, those prices should go up by about 20%. And if the market continues to be quote unquote healthy, because I know some people are concerned about the state of the market, but if inflation continues to be present and we don't have a recession, that 20% isn't going to do it. So we could see it increase by 40% or more in the next 2 years. And again, this could be limited by the terms of the debt. And it's also important to, give that some perspective. If those variable rate debt costs did increase by 40%, they'd merely be returning to their historical averages. Like we're not talking about forecasting something here as possible that's extremely unlikely, that's never happened before. We're just talking about getting back to what debt typically costs. So, it might make sense to put a little bit of a pause depending on, what your individual cash flow looks like on really gigantic projects, and maybe part of the projects that you need to tackle in the next 2 years now look something more like, how do I prepare myself for a business climate where debt is higher and I need to deleverage a little bit, or I need to have a little bit less debt. Not that debt necessarily suddenly becomes a bad word yet. We're nowhere near, 1979. We can function with some debt at current prices, or even if it's 40% more expensive than it is right now. But I think we definitely want to prepare for a climate where it's a little less hospitable and rely on it a little bit less. Andy, did you want to, I'm not sure you want to add anything to that discussion, but maybe you have some questions that could sort of help me along the way of maybe describing what these issues are to growers, and maybe help, maybe help me make the points that I'm trying to make here.
I think you're covering them pretty well, Kevin. I mean, with the cost rising so fast on all these, everything that growers need, you keep saying that this is a repeat. Well, in a way it is, but in a way it isn't, because you're trying to keep current with, what's going on price wise. And unfortunately, it's not positive. So hopefully maybe one of these down the road, you'll be able to say, okay, prices have really come down on this, and this, and it's
Right.
good news for growers. But
Yeah, I mean, I think you're right. I think the good thing about sort of the updates today is, um, your crop doesn't disappear because you don't engage in these costs. So the debt that you have, obviously, you're sort of stuck with until you can work through it. But choosing to do a big capital project and timing that big capital project, there's a business choice there. And obviously there's a risk, there's risks involved no matter what choice you make. We could have severe rainfall all summer long, and you could be really wishing that you had done that drainage project sooner. Or, the price of drain tile could fall back to historical levels, and you could save, $10,000 on 25 acres by waiting 6 months to a year. Both of those scenarios are possible. And the other thing is, if there's an element of debt to a project like that, it's not that you shouldn't take on new debt right now. It's that it's important to be mindful of where debt is and where it's going. So I think there is still a window to take on fixed loans right now. Looking at the mortgage market, lenders are still pretty reluctant to say that grapes are extremely valuable and by the acre, and give you full value for what an acre of grapes is worth. But the interest rates on grape acreage in a fixed sense is still favorable. But I would certainly be reluctant about variable rate debt, because I would expect that there's at least a 50 to 75% chance that that's going to be unfavorable shortly. And certainly relying it on it in a way that's unhealthy is certainly something I think growers are in a position to avoid right now, and they should. If you have some revolving debt that you don't really use very often, I don't think there's anything wrong with that. But if you're doing $100,000 tile project and that's how you're going to finance it, that's a little more problematic. And all these other prices are rising too, like you said. So I think most growers know what they need in terms of cash to get through harvest. But over the longer term, there are some unknowns there in terms of what's Roundup and fertilizer going to cost next year, and are the price of grapes going to justify it? So having that healthy cash flow and a little bit more reserve than you would normally have probably makes a decent amount of sense right now, just to prepare for 2023. But anyway, thank you all for joining us. I hope you found this update helpful, and hopefully next week we will get to talk about something a little bit different. I'm sure we will, but hopefully we're not just avoiding these rising costs when we talk about something else. We hopefully we start to see these things level out as we have in some areas over time, but it does seem like we continue to get hit with one thing after another. So hopefully this is the end of that. And grape prices have continued to perform very well. We've got a few updates in the last month or so, and everything does continue to look healthy, both on the retail end and on payments that growers are receiving. We'll know more in the next couple of months as well, as we know a little bit more every month. So, but everything does seem to continue to point to high prices. And I don't think we necessarily know for sure that that's going to continue for the 2022 harvest, but it does look very good for the 2022 payments that our cooperative growers receive for the 2021 harvest. So that's all good news, and that's going to continue to put people in a position to help deal with these higher input costs. That's all I have for this week, and we will be back next week with more. Thank you again for joining us, and please feel free to reach out if you want to hear about this or something else.